Hello, good afternoon, everyone. Thank you for joining. We've still got about 3 minutes left before this officially starts, so we'll wait a while. There are more people joining. Hello and good afternoon, everyone. It's 3:30 now. We'll just wait a little longer. We've got about 20 people who've joined. We'll just give them a few more minutes and then we'll officially start the session. Right, everyone. We'll just take a couple of more minutes and maybe by 3:35 we'll start, and I'm sure people will just keep joining. So just please bear with us for another 2 minutes and we'll start off. Right, it's now 3:35 and we'll start. Hello, everyone. My name is Reshma Zahir, and thank you so much for joining us today. Before we begin, I wanted to just take a moment to talk about ACFI Women Empowerment Task Pillar. I would request as many of you to please have your videos on. It just helps, rather than being in this. It's bad enough that we have to do this virtually. So if we can see each other, it's always good. It's nice to connect. So before we start, I want to take a minute or so just to talk a little bit about the ACFI Women Empowerment Task Pillar. Our mission is to create a strong platform that supports women in the air cargo and logistics industry through mentoring, networking, and learning opportunities to make sure that you stay connected with our initiatives and our upcoming activities. It would be best if you could please fill in the Google form. It's shared in the chat. And that's actually the best way to receive updates and be part of our growing community. With that, now I'd like to talk a little bit about today's session. When we talk about empowerment, we focus a lot on careers, on leadership, on opportunities. But one area that truly, truly underpins all of this is financial independence, financial wellness. Having the confidence to manage and grow our money gives us the independence and peace of mind. And that's what today's session is all about. We're really privileged and honored to have with us Binal Gandhi. Binal's an author. She's also CEO of the Learning Curve Academy and founder of Finance Gym, GYM, Grow Your Money, which is a gamified financial education platform that has engaged over 20,000 young people and has also clocked more than 100,000 hours of teaching across the corporates, colleges, and schools in India. Binal's work has also been featured in the Economic Times, the Hindu, Business India, and she's also appeared on a number of television shows at CNBC, ET Now, etc. Interestingly, before becoming an entrepreneur, Binal spent almost 20 years in corporate finance and mergers and acquisitions, working at organizations like GE Capital and Wells Fargo. She's also taught corporate finance and wealth management at schools like SP Jain. Binal has volunteered her time to be with us today and to share with us Money Matters, 5 steps to financial wellness. I'm sure we're going to walk away with a lot of practical tools we can start applying. Just one quick note, if you have questions during the session, maybe Binal, with your permission, it would be best to drop them into the chat unless you want to address them there and then. And then at the end of the chat, we can always come back. There will be about 10 minutes for question and answers.
That sounds perfect.
We can't hear you, or is it just me? I'm sorry.
Now, can you hear me?
Yes, I can. I can.
Okay. Yeah, that's perfect. We'll take questions at the end.
Okay. And so just drop your questions in the chat box so that you don't forget, and we'll also come back to it. I've got my colleague Simran, who's very kindly volunteered to do the question and answer session at the end of this. So over to you, Binal. Thank you so much once again.
Yeah, thank you so much, Reshma, for having me over. And thank you, Simran, for coordinating all the logistics. I'm really happy to be here this afternoon. And let me start by just sharing my screen. Okay. Can all of you see my screen?
Yes, we can. Yeah.
Okay, perfect. That's great.
Yes.
So again, thank you so much for having me. And a few years ago, I was conducting a session at Tata Institute of Social Sciences, and very, very bright students. And as I started, talking about investing, one of the students raised their hands and asked me, question. And basically he said, he's like, why are you teaching us how to grow your money, how to invest? When what we should be doing is whatever money we earn, we should be giving to the poor and the needy. So, why are we even learning about investing? And, that's when it hit me that, we each of us have such a different attitude towards money. And money means such different things to all of us. And so, what I wanted to do today was start with a very quick poll and ask all of you, what does money mean to you? Is it status? Is it success? Is it means to an end? Or is it root of all evil? There are no right answers here. But if you could take a minute, that would be great. Simran, could we share the results? Great. So we can see here that 65% of us feel that that's a measure of success. 24% means to an end. 6% feel it's status or a root of all evil. When we did a survey, for my book, Piggy Bank to Portfolio, How to Raise Financially Smart Kids, we surveyed over 1,000 parents. And what we saw was pretty much, an even distribution of how people felt about money. And, our attitude towards money really comes from childhood. It comes from how we were raised, what our parents believed in, and, what we saw around us at that time. And this is what defines each of our money stories. And they sound very, very different. I work hard. I deserve that new. I don't believe in spending a lot of money. Money should be saved for a rainy day. My partner is managing my money. I don't need to learn about it. I feel overwhelmed when I think about money. I need X amount of money to have peace of mind. I know how to manage my money and I feel secure about my financial future. I'm sure one of these stories also defines you. And then when it comes to managing your money, again, we do it very differently, right? But this money story really drives your financial decisions, right? So some of us, could be living beyond our means, maybe taking on too much debt, not saving enough for the future, or feeling comfortable and confident about our financial future. And when it comes to managing money, we do it in different ways. Again, depending on our money story. Some of us are focused on earning and saving, but we don't pay attention to managing our money. Some of us, give the money management to a trusted family member. Some of us use a financial advisor, and some of us do it ourselves. But either ways, no matter how you're managing your money, whether you're managing it or not, these are 5 steps today that I'm going to share with you that all of us need to know. And I'm going to break it down and make it very, very, very simple. And these are extremely important whether you're doing it yourself or whether you have somebody else managing your money. So let's start with the first step, and that is essentially to map your journey. So you need to know where you are first, right? And the first step is really to know what your net worth is. And very simply put, your net worth is your assets minus your liabilities. So what are your assets? Assets are essentially what you own, and this could be your house, it could be, your investment account, it could be your car. So these are your assets, and your liabilities are really what you owe. So in essence, so your loan that you've taken, your home loan or EMI for something else. So essentially net worth is what you own minus versus what you owe, very simply put. So let me ask all of you, how many of you know your net worth? Simran, could we share the results? That's great. So 67% of you say that you know your net worth. That's great. And for a third of you, it's not that hard and it's never too late. So this is definitely something that you need to do, once you get back home and when you find a little bit of time to figure out what your net worth is, because this is really the beginning of your journey. So once you know where you are, right? Yeah. Once you know where you are, you want to get down into the details and you want to know exactly where your money is. And this is really, really important to make a list of all your accounts and how you access them. And it's, God forbid, if something happens to us, your family does need to know where your money is. So what does this mean? This does not mean you write down all your passwords, but it definitely means that you, keep a list of all your accounts, your account numbers, and, someone in your family knows where this list is kept. And this means all your bank accounts, your brokerage accounts, your insurance policy. It's amazing how large the number is. Thousands and thousands of crores at RBI of unclaimed bank accounts, money that is just sitting there because people don't know that they've inherited this kind of money. So really important, to make that list of accounts. And a lot of people ask about passwords. Obviously you shouldn't be writing them down. But what my husband and I do, just to share with you, we have part of the password that we have not written down anywhere, that just the two of us know. And then the other part, the other half of the password is written down. So that way it's safe. But if something happens to him or to me, we both of us can access all our accounts. So that's one way to maintain the security, but at the same time, have access to all the accounts within the family. But no matter how you do it, you need to have that list with you. And the third part is really to list down your financial goals and to keep track of them. So what exactly are financial goals? I've listed some of them down: retiring early, or at whatever age you decide, starting a business, buying a vacation home, your child's education. So these are all actually life goals. And they become financial goals when you can give some form of a timeline there, and some form of an amount. So it's really important not just to know where you're starting, but also where you're going with your journey. And if you sit with a financial, if you have some clarity on these financial goals, you can sit with a financial advisor who can easily guide you, in terms of how much money you need to set aside, how much money you need to save every month so that you can achieve some of your goals. Or, depending on how much money you set aside, you may have to readjust some of your goals. But either ways, it's important to know where you are going. And if people are interested, we can definitely have another session, which will be, more detailed in terms of how you can determine how much money to, set aside for each of your financial goals. We won't go into details today. So once you've mapped your journey, the next step really is to set aside some money as your savings, right? And I think it's always a challenge for people, no matter what age, to balance their saving and their spending, right? Spending is for today, and we don't want to, let go of today. We want to enjoy today, and saving is for enjoying in the future, right? And there has to be that right balance. So how do we maintain that balance? So let me ask you that. There are two ways of saving. Both these equations look the same, but let me tell you. Number one is when you spend your money, right? And whatever is left over is your saving. And the second method is when you decide how much you want to save, and income minus the savings is what you end up spending. So how do you save? Is it method one or is it method two? Simran, could we share the results? So about half and half, a little more do it the second way, which is absolutely a much better way of doing it. Deciding how much you want to save, just so that you have more control, and then spending the rest of the money. But for the 40% who don't do it that way, this would be a great time to get started, in terms of how much you want to set aside. Once you've defined your financial goals, and then maybe spend the remaining amount, instead of doing it the other way around. So how do you set aside or know how much to save? And how do you balance? I guess once we launch the poll, it somehow gets hung. Okay, perfect. So a lot of people plan and budget. So they create a budget. They know how much, their monthly expenses are going to be, right? And based on that, they decide how much they can save, right? And then they end up saving that much and spending rest of the budget. But this is, a little hard, not that easy for everyone. There are a lot of impulsive shoppers, maybe some amongst us. There are some hacks that are recommended that people follow. I don't know how many people actually follow them, but there's a 1% rule, which is essentially if you're going to spend 1% of your income on anything or more than 1%, then you should wait for 24 hours. So that you're not being impulsive. A lot of people don't have credit cards. They don't carry credit cards. They either carry a limited amount of cash or they use debit card. So there are some of these hacks that we definitely could use. But for most of us, when it's hard to budget, what I would recommend is to actually set up 3 bank accounts and keep this really simple. So, number one, follow the 80-20 rule. And this could be a little different for you guys, but essentially spend 80% of your income and save 20%. But you may decide, for you, the rule is 90-10 or 70-30. That's fine. And instead of having just one bank account, open 3 bank accounts. The first account is where your income gets deposited, right? And the second account is where, which you will call your spending account, is where you transfer, as soon as your paycheck comes in, you transfer, let's say, 80% of your money. And the third account, which is your investment account, you transfer 20% of your money. Now, with technology, the good part is we can automate this entire process, right? So all we have to do is focus on the spending account when we're spending. We don't need to worry about our budget. We don't need to worry about, we've already done the planning ahead of time. So on a month-to-month basis, we don't need to worry about did we spend more, did we spend less, right? We've got money set aside in our spending account, and that's the money that we want to spend. And like I said, with technology, this can easily be automated. Let's say you get your paycheck 5th of the month, come 6th, the money can automatically move into these accounts. And then from your investment account, again, you can move it automatically. And we'll talk a little bit more about that a little later. So, easy way to balance your saving and spending once you've done your planning, and much easier than to actually budget and to follow your budget. If you have the discipline of following your budget, of course, that's great. But this, in my mind, works a lot better. So once you've planned and set aside or decided how much money you want to save, the third step really is to plan for contingencies. And all of us need to set aside money for an emergency fund. Okay. And how much money do you need to set aside? So that depends. Let's say, you are working and you're a salaried employee. And in your mind, let's say you lose your job for whatever reason, it'll probably take you 3 months or maybe 6 months to find a job. If you're more senior, it could take you even longer. So depending on how long it takes you to find your job, that's the amount of money you need to set aside. So typically, the recommendation is 3 to 6 months of expenses. But let's say you want to start a business or you own a business. In that case, you want to set aside maybe 1 year of expenses because the uncertainty is a lot more. And again, this money can automatically be put into either a recurring fixed deposit or an SIP into a short-term mutual fund, which is very, very easy to do. So really important to create an emergency fund. If you haven't done this already, then I would highly, highly recommend that you create a fund as soon as you can. The second thing to do is to have your own health insurance policy. So if you're employed, many of you are covered by your employers, but please do recognize that you may decide to change your jobs. You may decide to retire depending on your age. And, at some point, you will want continuity in your health insurance, right? Because there are certain restrictions before certain illnesses are covered. So, so even though you have health insurance, maybe with your employer, you may want to consider a health insurance policy of your own. When you start younger, obviously the costs are lower, and there's a lower chance of rejection. But more importantly, there's no waiting period and there are some accumulated bonus benefits that you get. So don't wait till you leave your job before you get health insurance. A little bit of planning really helps out in the long term when it comes to health insurance. The third thing is to buy life insurance. Now, there are many different types of life insurance. I think all of us are familiar with LIC policies, and many of us have purchased those. Now, LIC policies essentially combine life insurance with some form of investments. So, what you will see is the LIC policy premiums are much, much higher than regular, what we call term insurance policies. And these are policies that are pure insurance. So their premiums are a lot much lower than a typical LIC policies. What I would urge you to do is buy a term insurance policy because it is the cheapest. And buy it when you are, younger, because again, then you have the premiums locked in for a longer period of time. The problem with LIC policies is that you do end up spending a lot more on the premiums. Yes, you do get some money at the end when the policy matures, but the problem is we don't know if that money even beats inflation, right? So that's the part that you have to keep in mind. So my recommendation would be buy the cheaper term life insurance with a good company where you know that they settle the claims very easily, just like Life Insurance Corporation does. So how much term insurance should you buy? So this is a very important question, because what I have seen is some people are underinsured, they don't have insurance, but there's a lot where you'll see people have overinsured themselves. So I'm giving you a simple, very simple rule of thumb in terms of how much coverage you need. So essentially, whatever your household expenses are, multiply that by 10, plus any loans that you may have, so any liabilities, and then minus any investment portfolio that you have. So this is a very simple calculation. Now to this, you may add any upcoming financial goals that you may have. So you may increase the policy amount by the coverage amount by that amount. But essentially, this is a very, very simple formula that at least will give you some amount of guidance in terms of how much coverage is the right coverage for you. So now we've set aside some money. We know how much we want to save. We've planned for emergency. Now, what do we do with the money that we have saved? Should we just leave it in the bank account? We cannot, because even though all of us have very, very different money story, the one story that is common to all of us is inflation. And I think we all know what inflation means, but I just want to illustrate it to you in a different way. So in 2025, 250 rupees is going to buy me a simple Starbucks coffee. 10 years from now, in 2035, that 250 will probably get me a coffee, yes, but maybe not Starbucks, maybe at my local coffee shop. And then another 10 years, the 250 I may not even be able to afford coffee at my local coffee shop. Maybe this is what I'll be able to afford, filter coffee. So inflation essentially eats away at our wealth. And this is what a lot of people, even though they know, we all feel the pinch of inflation over a long period of time, we don't realize how much it is hurting our savings. So with a 7% inflation, which is historically what on an average our inflation has been, the value of our money halves in 10 years. So essentially, if you're going to keep that money in cash, then you can buy only half the things 10 years from now than what you can buy today. It's eating away at your money. And today the inflation is a lot lower, but you don't know what's going to happen in the future, whether it goes up or whether it goes down. But either ways, what is, applicable for all of us is that inflation is eating away at our money. So what do we do? So we need to invest our money. And this is a slightly older chart, but I like it because I want to show you how different kind of investment avenues, how they help us combat inflation. So let's start from the right-hand side. If you look at cash, over a 10-year period, you're definitely underwater. I mean, you definitely cannot hold cash because your money should have been worth 179, but it stays steady at 100, right? This is because of inflation. In the savings bank account, yes, you are being paid some amount of interest, but let's say today, it's 3 to 4% of interest in your savings bank account. And so if your money grows by that much, you still cannot beat inflation. And all these numbers actually don't take taxes into account. So government bonds and bank FDs, you can see that they're going slightly over inflation. But again, what this chart doesn't take into account is taxes. So if you're paying some amount of taxes, again, you're underwater when it comes to FDs. Gold, well, especially this year, gold has done very well. But in essence, over a longer period of time, if you keep a longer horizon in mind, gold has been one of those asset classes that has beaten inflation, right? You've got, PPFs, you've got real estate. Again, you can see that, they're beating inflation at a higher and higher rate. And then you've got your stock market and mutual funds. So what we see is equity, which is essentially buying stocks, whether you do it through mutual funds or you do it directly, is one way to protect your portfolio against inflation, right? Another way, of course, is to invest in real estate and gold, which we all do. And that's always been the traditional asset class where all of us Indians invest, right? But you can see here that the maximum protection against inflation, at least over the last 10 years, has been through equities. But equities are volatile. Markets go up, markets go down. It's really scary to invest in the stock market. But what most people don't know is equities are volatile in the short term. So markets do go up and down. This year markets are flat. Last year they went up significantly. Next year, who knows? They may go down, right? But if you invest correctly in the right instruments and if you stay invested, then equity gives you the growth that you need to combat inflation. So a lot of times what happens is people trade equities. They buy, they sell. If it goes up a little bit, they'll sell to book profits. If it goes down, they sell, they book losses. But that's not the right way to invest because equity is volatile in the short term. But the right way is to invest and hold the equity for the long term, right? And what we see is that most people who trade don't make any money. So this is something that data that Nitin Kamath shared with us, right? That less than 1% of active traders earn more money than a bank fixed deposit. 99% of them don't make any returns over a 3-year period. Why? Because they're actively buying and selling, right? So what is the right way to invest for the long term? So with that, let me ask you, do you invest in the stock market, whether it's directly through stocks, or do you invest in mutual funds? It could be do it yourself or through an advisor. Simran, could we share the results? That's great. So again, 67% do invest, which is great. And 1/3 of you don't. And I would seriously urge you to not keep all your savings in fixed deposits or even in cash in your bank account. Do take the effort to invest at least some of your savings in equity. It's really, really important to do that because, like I showed you, equity gives you growth in the long term. So, and you need that growth to beat inflation. So now, how do you invest in the stock market? This is key. So there are different ways. Now, this was not available to us 20 years ago, but now we've got many, many, many different products in the stock market. And let me start with the bottom, okay, which is investing directly in stocks. So this is where you need to choose companies. Okay. You need to choose companies. You need to decide, many cars are selling, government has reduced the GST. So, suddenly the car stocks are starting to look very good because they're making higher revenues. We've seen that in the papers recently. So you need to keep track of all these stocks. You need to keep track of the news related to these stocks, right? You could certainly outsource it to someone, but if you're doing it yourself, then this job is almost, you could say, a full-time job. Really hard to keep track of these companies on a regular basis. Not impossible. A lot of people enjoy doing it. I'm not talking about trading, which is buying and selling based on tips, but I'm talking about actually doing your research and keeping track of the news and investing. The second easier way is to invest in the stock market through mutual funds. Now, this is where you're actually outsourcing this work of keeping track of your companies, right? The fund manager is doing this full time. So when you choose a mutual fund, you actually only have to choose a fund manager. You don't have to worry about keeping track of the news. You don't have to worry about keeping track of whether the company stock is up, down, should you buy, sell. The fund manager is doing that for you. So it's a much, much easier way to invest than direct stocks. The other very big advantage of mutual funds is that they are extremely transparent. So their performance is very, very, very evident. They have to give you all that data on the monthly basis. It's available publicly. So it's very easy to keep track of how the mutual fund manager is performing and versus his or her peers. And, if you have a broker, and if you're investing your stocks through a broker, is the broker sharing that information with you regularly? Is he comparing his performance with the other fund managers? It's very important. And this is the big benefit that mutual funds give you. Now, many people, especially when you're starting out, struggle with choosing a fund manager. And I've seen many a times where because, you have to make these choices, you kind of procrastinate and the money sits in your bank account. So what I would really urge you to do in that case is to invest in the simplest product that is out there in the market, and that is called the exchange traded fund. Essentially, what this exchange traded fund does, or an ETF, it invests in the stock market in general. So you may have heard, all of you may have heard of the Sensex. The Sensex is essentially an index, right? You've heard Sensex going up, Sensex going down. The Sensex is essentially an index that keeps track of the stock market. It consists of the top 30 stocks in the market. So it gives you an average performance of the market. And essentially, this ETF only mimics this Sensex, right? If it's a Sensex ETF. ETFs can mimic other indexes also, but let's just talk about the Sensex ETF. So in that case, it just mimics the average of the market. So if you feel that I'm having a hard time, or I don't have time to select a mutual fund, I don't have time to meet with my financial advisor. I'll do it next week. I'll do it next week. Many a times we procrastinate. In that case, what I would urge you to do is invest in an ETF because it's very simple. All you have to do is either you have a brokerage account, right? Or you can even invest through mutual funds. And this ETF will give you an average performance. Many a times what happens is, for those of you who have a financial advisor and you choose a mutual fund with the help of your financial advisor, in a few years you realize, the fund manager is not performing as well. Then you sell that fund and choose another one, right? And overall, maybe your portfolio does not do as well. So, in trying to select an above average performance from a fund manager, your portfolio may go below average. So in that case, maybe it's just better to stick at average. Sometimes average is better, especially if there is a chance of you going below average when it comes to your performance. So in my mind, the easiest product that we have in the market that will help us beat inflation, that will give us the benefit of the stock market without doing any work, really, is to choose an ETF. You could choose a Sensex ETF or a Nifty ETF. Sensex belongs to the BSE, which is the Bombay Stock Exchange. Nifty 50 belongs to the NSE. But essentially, they are similar. And just choosing that will give you the benefit of the stock market. So, something for you to keep in mind, that you don't always need to invest in something so complicated, right? Like stocks, or for some people, even mutual funds could be complicated because there's a lot of choice. And ETF is the simplest way to go. So sometimes I would say that boring is good, where there's less work, and just stick to it. Because like I mentioned earlier, active traders, there's a lot of excitement when you trade, but what ends up happening is, you don't necessarily even end up beating the fixed deposit returns with your market. The most important thing to keep in mind, and some of you may have already heard this term, is the power of compounding. And I told you earlier that yes, the equity markets are very volatile. 1 year the markets go up, 1 year the markets come down, and these ups and downs are huge. In 2008, the markets were down by 50%. Can you imagine your portfolio being halved? It's a very scary thing to see. But if you invest and hold on through all the market's ups and downs, what you will see is your money growing. So you can see here, the blues is your investment amount, and the red is your money growing in the stock market. And you can see over time, the difference between the blue and the red is growing significantly. So the key is to invest. And if you don't want to make too many choices, invest in the market index through an ETF and stay invested through all the ups and downs in the market. And what you're going to see is even a small investment of 2,000 rupees per month here, for example, will get you to 1 crore in 30 years. So, lots of books and talks about how to become a crorepati. This is the simplest way without doing anything. Little boring, but very simple, and there's nothing to do. The best part now with technology is you can just automate this through your investment account. Every month a fixed amount of money can go to your SIPs. I think all of you probably have heard of systematic investment plans, which is a fixed amount, and you can decide what that amount is going into a mutual fund or an ETF on a regular basis. So yes, it's a little bit of work to set it up, after which it's all automated. You don't need to look at it. So that's the right way to invest in the market. The last step is really about borrowing. When we borrow money, essentially what we are doing is we are stealing from the future, right? This is money that, our future self could have earned, right? Or could have used, essentially. And borrowing comes with a cost. You have to pay the interest. So, and now, when we buy even the smallest thing on Amazon, you have your EMIs, and, you can buy it over a few months or a few years. But do remember that there is a cost. To most of these things, there is an interest that you are paying. So, in order to buy some assets, we do have to borrow. All borrowing is not bad. But ideally, what you should do is borrow for appreciating assets that increase, which could be like a home loan or something like that. So with that, I want to share some final thoughts. Number one, which is that women tend to be less involved when it comes to investing for their families. And I'm so happy to see that we have so many women here today. So women should definitely get more involved. But very important thing is to include your entire family in the financial decisions. And lastly, but again, very important, is talk to your children about money. You don't need to share your net worth with them. You don't need to share your investment portfolio with them, but you need to start teaching them a little bit about money, a little bit about inflation, how it's eating away at your money. Maybe you could give them a small investment portfolio, few thousand rupees, so that they can learn how to invest in the stock market, how to invest in mutual funds. There are so many things that you can do, practical things that you can do with your children, so that when they start earning money, they're not struggling in terms of what they should be doing with their money, how they should save, and all of that. Money should not be a taboo topic at home. And if any of you are interested, for tips in terms of what you can share with your children, in my book, Piggy Bank to Portfolio, we share a lot of very practical tips about what you can teach your children about money. So with that, I want to open it up for questions.
Hi, good afternoon. Thank you, Ms. Binal, for that insightful session. As she said, we'll open up now for questions. I would request everybody who has a question to either just unmute themselves turn by turn and express your question to Ms. Binal. She will answer. And then we can move ahead.
Simran, I just have one point, please. On the last slide where Binal's written her contact details, is it possible for us to copy paste that into the chat box so that in case anyone wants to get in touch with Binal separately, it's easy to access?
Absolutely.
Sure, if you could just
Yeah,
share it on
Binal,
the
maybe if you
on
could just
the
put that
yeah.
in on the
I will
chat,
do
that
that.
would be great.
Yeah,
And maybe
I will.
also the link to your book would be very helpful, because I've got one teenager who desperately needs to be taken through it.
Sure, absolutely.
Thank you.
What I can do is, if it's okay, I will share the book with the link with Simran, and she can
Okay.
pass it on.
Yeah,
Yes, yeah, that
perfect,
would be.
perfect.
And I'll do the same with my contact details.
Okay.
Okay, yeah. We have a question from Miss Jyoti Roy. She asks, if I want to invest in mutual funds, how to start it and what will be the best company to invest in?
Yeah. So that's a great question. How to start and also which company to invest in. So there are over 50 different companies that are offering mutual funds, and there are thousands of mutual funds to choose from. So which is why it can be a little intimidating. So what I would suggest that you do is get started first with an ETF where you're not necessarily choosing a mutual fund, right? So immediately get started with an ETF. I'm not going to recommend any products here, but there are many large, known banks that also have AMCs like SBI or HDFC, right? Or UTI. These are all very trusted names, ICICI. So any of those, they all have a Sensex ETF. So any of those would work. They also have a Sensex index fund. So you could, if you have a brokerage account, then you can invest in the Sensex ETF. If you don't have a brokerage account, then what you could do is reach out to just go to, I'm taking SBI as an example. You just go to the SBI mutual fund website. You can create an account and you can choose the SBI Sensex Index Fund or the SBI Nifty 50 Index Fund. Both those are similar, as I told you. And you have to do your KYC, but it's a very straightforward process now. Even 2 years ago, it was a lengthier process to do your KYC, etc., etc. But now all of it can be done online. So you can very quickly create your account and set up an SIP and do it directly through any one of these AMCs that are very, very known. So that would be a great first place to start out. Is start with, if you have a brokerage account, then an ETF. If you don't have a brokerage account, then go to the website of an SBI mutual fund or an ICICI mutual fund and find the Sensex index fund and go through the KYC process. Very easy. All of it can be done online. You can set up your SIP. Now, if you want to go deeper and select some active mutual funds, in that case, what I would highly recommend is that you find a financial advisor who can help you select, because there are thousands of mutual funds to choose from. And if you're new, then it's very hard to do it yourself. So it makes a lot of sense to actually have a financial advisor who can help you choose a mutual fund. But let me give you a few tips on how to choose a financial advisor. So one of the first few things that you need to ask the financial advisor is if they will actually be able to help you with your financial goals. So typically, a financial advisor will want to understand your situation. Okay, how many kids do you have? How large is your family? What are your liabilities? What are your assets? And what are your financial goals? And then they can help recommend a product to you. Sometimes what happens is advisors will just recommend a product without knowing who you are. And that, is not the right approach. Essentially, what they're doing then is just selling a product to you, right? So it's always better to, find someone who actually wants to know what your financial goals are, what your situation is, and then recommends products based on that. So very long answer to your question, but hopefully that helped.
We have another question from Miss Ashwini.
Yeah.
She says, what about SIP? You can suggest any good company. She has a demat account and doing trading, so she is hoping that you can help.
Yeah, absolutely. So So again, like I mentioned, I will not be giving any product recommendations in this session. But in your Demat account, if you want to invest in specific shares, then I would suggest that you do your research. And it's a very good idea to do an SIP into shares where you're putting a fixed amount every month rather than just putting a lump sum in a particular share at one time. So I'm not going to recommend any products here, but what I will tell you is do your research and invest in a product or sorry, invest in a stock that is going to do well over the next few years. So a lot of research required. Please don't just go on tips. Do not invest on tips because generally most of the times, they could be wrong. Sometimes the tip could be right. You buy the stock goes up, right? But then you don't get a tip of when to sell. So what happens is you end up holding the stock and it's not done as well, as it should. So, trading on tips, again, not a very good idea. Do your research and then invest in a stock. But you could also do an SIP into these ETFs. Okay. These ETFs give you a diversified, right? Like the Sensex ETF invests in 30 of the largest stocks on the stock exchange. So if you have a Demat account, then a Sensex ETF could be a good option for you to invest in because you have a diversified portfolio. You're not taking risk with just investing in one or two stocks.
We have another question from Mr. Joshua. If equity share is in loss since very long, should we sell or hold? And is NPS good or VPF?
Okay. So if a share is losing money, then should we sell or buy, right? That is the question. Um, so, uh, so essentially, when you invest in a stock, and which is why, I always say that investing in stocks, especially if you're doing it yourself, is really a very difficult task. Because when you invest in a stock, you're essentially looking into the future. You're looking into a crystal ball. And the stock price really reflects your future cash flows. How the company is going to do in the future. Are the revenues going to grow? Are the profits going to grow in the future? Maybe the last 2 years they were in a loss, but that's because they were doing some capex and they were investing and so on. But the future could look great, right? So when the when the stock is losing money does not mean that the future is not going to look bright, right? So to make a decision on whether to invest in a stock just because it's lost money in the past is a absolute wrong way to look at it. The right way would be to see how is this company going to do in the future, which again is not an easy task because you have to be able to look into the crystal ball and say, is this company going to grow? Are the revenues going to grow? Is it going to make profits? Is the returns going to be good? So if you have the ability to evaluate and analyze that, then you should invest in the company even if you made a loss in the past. In terms of your provident fund, you definitely should invest in that. NPS also makes sense for certain employees, and the rules keep changing. So especially now, because you have a lot of flexibility with the NPS in terms of investing. So, definitely a product worth considering, especially over and above your provident fund.
Mr. Shashank has raised his hand. Mr. Shashank, do you have yeah.
Yeah, hi, good evening, Binal. Just
Hi, Mr. Shashank.
just wanted to know that I have taken a lot of LIC policies now. So after your suggestion and after recommendation, I'm planning to take for the term life insurance. As you said,
Right.
it's better than the LIC, what you say.
It's cheaper. Yes.
Yeah. So as soon as you said that, I just opened few this thing in the Google. I saw Axis Max, Tata AIA, blah blah blah, two or three. Out of that, I saw that they give life cover of 1 crore. Okay. covered till the age they're showing as 60 years, and then they show one option as claim settled, that is 99.4%. Can you
Right.
please just explain me how it is works? Is it similar like LIC, or it works in a different way or something like that?
Yeah. So
Because
the
I'm going to take it
claims.
for the first time. यदि मैं
Yeah.
term life
So,
insurance में.
so for the claim settlement ratio is a it's a very good indicator to look at to understand whether if you ever have to claim or your family has to ever claim on the life insurance, are they settling the company? I mean, are they settling the amount or not? Right? That's the key because you may end up
Okay.
paying premiums and if they don't settle, right, then what's the point? Correct? LIC has had an amazing has had an amazing claim settlement ratio history. So in many cases they've settled the claims without asking too many questions. But what we are seeing now is a lot of these private insurers, HDFC, Ergo, a lot of them also have, like you said, a 99.5%
Yeah.
type claim settlement ratio, which is a very high claim settlement ratio. So when you choose your term insurer, definitely look at your claim settlement ratio and it should be high, close to LIC.
Okay.
Definitely.
Uh,
So, yeah, go ahead.
sorry, please. Continue.
Yeah. So, before, so are you going to get this term insurance on top of the LIC policies?
Yes, my current running LIC policies are there. It's
Okay,
running.
great. So you will
I have.
continue and then you will buy term insurance on top of that.
So
Yeah.
I'm planning to take at least one now for term life insurance.
Yeah.
So how about the returns in this case in term life insurance? इसमें कैसा होता
So,
है?
yes. So that is the difference. So the reason why term life is so much cheaper is when the policy matures, let's say 25, 30 years from now, you will not get any money back,
Okay.
right? So in an LIC policy, what happens is you have, you're paying
Lump
higher
sum money.
premiums
हाँ.
because this product is a combination. It's a combo product of
Okay.
insurance plus investment.
Okay.
Right? So it's a forced way to invest also. Correct? So which is why your premiums are high. So at the end of the term of the LIC policy, you will get paid some money, some maturity amount, right? Along with some amount of bonus.
Yeah.
But for term life, there's zero. You don't get anything. It's pure insurance. Now, so then you'll tell me, then why bother? Why? It's just like, it's just I'm paying this money out and I don't get anything out of it. The reason why you are going for term life is you get a lot more flexibility, right? Because the insurance, the premiums are so low. Let's say, God forbid, but you lose your job,
Yeah.
right?
I saw,
Because
yeah,
LIC
Axis का
premiums are
कुछ
so
something.
much higher,
Yeah.
it's hard to pay those premiums when you don't have an income coming, right? But you have to continue it because your insurance has to last.
Yeah.
But term life is a lot cheaper, much easier to continue. So what happens is term life gives you the flexibility because it's pure insurance versus LIC's insurance plus investment. So less flexibility. Also, the returns from LIC are, not close to equity returns. What you'll see is they are closer to fixed income type returns, right?
Yeah.
So what you could do is buy term life. Whatever money you save in premiums, you could invest those in equity mutual funds, right? So net, you will be much ahead when it comes to growing your portfolio. Does that kind of make sense? So you have
Yeah.
flexibility in terms
Yes.
of investing.
Right. Okay.
So in the old days, we all went for LIC policies because we did not have that many options. There
Yeah.
weren't that many private insurers. They did not have good claim settlement ratios. But now the market is changing. So
Yeah.
now it makes a lot of sense to buy term insurance.
Okay. Thank you. Thanks.
So,
Thank you.
yeah,
I
thanks. Thank you, Binal. Thank you, everyone. Thank you, Simran. Binal, clearly there's so many questions that people have, and that's why I was so keen that we share your coordinates with everyone, which Simran will do. I just want to say that I think thank you so much, Binal, for breaking it down, the financial wellness into some very simple, practical steps. I was quite blown by the password trick about, remembering half of it and writing half of it. For me, that was was almost like a game changer. I think a lot of us are going to walk away from this session with a lot more clarity, and hopefully, more than the clarity, the motivation to start, looking at our financial wellness. Just to end, on behalf of the ACFI Women Empowerment Task Pillar, I want to say a big thank you to everyone who joined us today. And as I mentioned at the beginning of our session, I do want you all to please take a minute to complete the form that we've shared in the chat box so that we can stay connected and keep you informed with all our upcoming activities and events. We're very keen to build this community. And if there are any suggestions and ideas that you have, please do write in to us. Simran, if you could share the ACFI Women Empowerment contact details as well, it will help. With that, once again, Binal, thank you so much for your time and your expertise, for your generosity in spending this time with us, and more than anything else, for the audience, thank you so much for your engagement. And I look forward to seeing you all at our next session. Thank you so
Thank,
much.
thank you so much for having me.
Thank you,
Thank
Binal.
you.
Thanks,
Thank
Simran,
you
for
so much,
organizing
ma'am.
this.
Thank you. Thank you for
Thank
your
you.
time. Thank you.
Thank
Thank
you
you.
all.
बढ़िया था यार। आपका पॉइंट नहीं लिया सर, नहीं वो एनपीएस। हाँ, तू बता क्या बेटर है।